morning, good afternoon, good evening, yWhales, wherever you are in the world. Today is one of those really exciting and slightly different specials. We're not going to be talking too much crypto, certainly going to be a little bit, definitely no NFTs. Maybe we might dive into it slightly. But today we're with Andersen, and we're going to really start kind of diving into the responsible side of blockchain and crypto, which is your tax issues that you've created for yourself. While I am clearly unqualified to have this conversation, I've brought in Mr. Chicago Mike, and we have Ed and Hai from Andersen here to really help talk through, you know, how to start managing or thinking about your cryptocurrency portfolio as well as your tax exposure. So with that, let's go ahead and meet our two guests today. Ed, how are you, sir?
I'm excellent. Thanks, Jay. So, my name is Ed Schulte. I'm a managing director in Andersen's alternative investment funds practice in San Francisco. I work with cryptocurrency funds, hedge funds, and venture funds. I have about 20 years of experience working with alternative investment funds. However, the crypto portion of my portfolio has been building up over the last 5 years as it's a fairly new industry. And I just want to thank Jay for having us here today to talk about cryptocurrency taxation.
Absolutely. Hi, how are you?
Great, great. Thank you. Yeah, I'm Hai Tang. I'm also a managing director with Andersen. So my practice area covers venture capital, private equity funds, and their startup companies. In terms of crypto, I've been involved with crypto for the last 6 years. I've worked with over 50 companies or funds in this space, and some of them have grown into some of the best known companies out there in the crypto space, enjoying great success. Anyway, just happy to be here and speak with you. Again, these are all both funds and also companies that launch their own tokens through initial coin offerings. And again, I'll leave it there.
Awesome, awesome. So, quick disclosures for everyone out there. Anything you hear today is not your own financial advice in any way, shape, or form. If you like anything you hear or see today, please reach out to Andersen individually, and I'm sure they would be more than happy to have a consultation with you, and we'll get to that towards the end. But nothing today is general tax advice that anyone should listen to, other than a great conversation we hope to have here on the show. Mike, what's real quick? What's been your exposure right now in dealing with cryptocurrencies? Because you're a couple of years into this now. Have you felt good about those end of the year filings on what you've been doing online?
It's interesting. The first year, so for 2020, in 2021, I didn't really have a lot of complexity, and I really felt like I had a handle on things. And I think it's a tale of two cities, because now for 2022, looking back at 2021's filing year, things have gotten crazy. I had started yield farming and started working on things that I think probably subject me to questions that are not easily answered. And I think a lot of us feel the same way, that we're looking for guidance. Obviously, we're hopeful that there's a lot more crystallization in the next few years. But for 2021, a lot of people did a lot of new things and tried a lot of new things, and maybe near the end of the year felt like they ended up down, although their tax bill might show otherwise. So I'm excited to hear what these guys have to say about recent court cases, about their experience with the IRS, and also I guess another question people have is, what to do with the whole concept of NFTs, and if you minted an NFT, do those costs offset the gains? And if you held them and they went up in value, and then you sold them, do you owe, et cetera, things like that. So we're all really curious. I've been thinking about what the best practices are, but in general, I don't know anybody that's happy or comfortable with their filing concept. And it's not about the money they're paying; it's just the uncertainty.
Yeah, no, and I thought that we might avoid the NFT conversation. You made it clear there's
Maybe
not a
not.
chance of it. So there we go.
I don't think so.
Yeah, so Ed and Hai, let's jump back over to you guys. We're very excited, but let's first start with Andersen, and what you guys offer today and the types of clients that you're seeing coming in, and then obviously we'd love to run through your deck and really understand the offerings that you have for those of us that are a little heavier than others in the cryptocurrency space.
Sure, I can talk a little bit about the clients that we've seen. Obviously, there's the investors, which includes individuals and also funds that, for example, venture capital funds or hedge funds that invest in the space, and some are um, buy and hold, right? So, for example, they could buy new cryptocurrencies on a pre-sale basis or SAFT before the tokens are launched, and then they hold it for a couple of years, and finally the tokens are launched, and hopefully they make a huge amount of money. And I've seen people making a huge amount of money in Solano and a lot of the new cryptocurrencies. Great, and there's some are just trading, right? The traders, they trade, Bitcoin, Ether based on the volatility. Again, they can also make a lot of money. And one of my clients is, basically a high frequency trader. They're basically it's just so easy for them to make money. At least that's their sentiment. There's also
Easy to lose it too, though. Unfortunately.
if you have depends on your algorithm. Anyway, the other side of the coin is the companies that are issuing new cryptocurrencies, right? I mean, ICO or initial coin offering was all the rage in 17 or 18, really, before the SEC kind of started cracking down. And, some of the firms were reached out by the SEC to basically, hey, you didn't follow these rules, and a lot of them have to settle with the SEC. And we're seeing a little bit of a revival, mostly offshore initial coin offerings. It's cautious, but we're seeing more of that. I'll leave it there. And Ed, you have any more to add?
Yeah, so I guess one area where I differ from High is I'm strictly in the fund space, and so we're working with professional investment managers. We're also working with family offices, and kind of as these things develop and evolve, what we're seeing is a lot of our clients jumping into these new revenue streams before fully understanding the taxation. And one of the reasons they don't understand the taxation is there isn't guidance on how certain things should be taxed. But everybody's kind of moving forward, and then we're coming in and kind of assisting people with figuring out the right way to do things, the proper positions to take on their tax return. What we do find a lot of also is people just trying to figure out how they organize the data. So how to organize the economic data, and then we can apply taxation to it. So there, there's a hurdle even before that, just compiling the information. And I think early on in the industry, people weren't tracking this information very well, and so it's kind of led to this as the industry has grown up a little bit in the last few years. You're seeing a lot more internal controls and a lot more questions and a lot more scrutiny.
And it's really interesting to think about the changes just in the last 2 or 3 years. In the span that you guys were really talking since Andersen has kind of gotten much deeper into this, which is there. Not only is there not any clear regulation and clear guidelines for people, but the protocols are changing so rapidly, and the asset class is just in the last couple of years tripled, from less than a trillion to at one point it hit 3 trillion. Now it's back down to about 1.5 trillion. But as we kind of continue to think about how do you plan for this, it's really hard when in the middle of the year there's a new regulation that will come down or a new ruling, and it changes everything. We just heard recently that staking and the rewards you get from staking are no longer a taxable or may not be a taxable event. I don't want to say for certainty, because even though the Supreme Court said it, doesn't mean that someone's not going to change it before the time this thing airs. Are you guys seeing, how do you even track that level of volatility?
Yeah, we obviously get these updates closely. We got our news sources, and also conferences, and to try to keep track of it. There, unfortunately, there even though the industry is evolving rapidly, there haven't been many cases or rulings. So there are some legislative attempt to try to change things, like the Build Back Better Act. Unfortunately, I guess also you could say it's fortunately it didn't get passed. So we're still left in the dark on many issues, and anyway, do you have anything to add?
So
Yeah,
there's
no,
there's no great way. Like it's just you guys are having to put in that much work.
well, we definitely have working within a public accounting firm. There's an infrastructure and there's services that provide you timely information and feed it to you. But I think a lot of time, sometimes, you know, we sometimes hear things from our clients because some things start as rumors. I think with the change to staking income, I don't believe that there's a court case yet that has set a precedent. But we do hear about that and things bubble up. And I think sometimes the way the media portrays things is they make something seem much more certain than it actually is. Um, and so you just got to understand that when you're reading media reports, what we do is we're going to go directly to the court cases and the rulings to see what they actually say.
But the issue that you guys are talking about in terms of spotting regulatory changes is going to probably be pretty frothy in the next couple of years, even as some certainty from the IRS and from the tax courts and of course the district courts and then even the administration happens. But before we get to that point, what percentage of your clients that are not crypto funds, but percentage of your clients that are what we would call more TradFi, whether they be family offices or closely held or publicly held corporations, are actually asking you for crypto advice? The question comes out of a suspicion that there's a healthy number of clients that are now asking you, even if they're just dipping their toe in the water, is it 5%, 10%, 50%? And everybody, what's the thermometer like right now on this topic inside the firm? I guess from both of your perspectives, other than the crypto funds, which I think is self-explanatory.
Yeah, well, obviously the crypto funds are asking the most questions, but anybody that's dipping their toe into this space is gonna have questions. I would say it's probably like 20% of my clients. So some of my funds are, the agreement mandates a certain type of investing, and they'd have to change the agreement to do crypto investing. But some will change the agreement, and some have the flexibility to do that. But we do probably get about 20%. But I would say right now the funds that are launching are predominantly crypto funds. And so typically in the past, I would have a portfolio of a lot of hedge fund clients that are trading marketable securities. That's really shifting towards cryptocurrency launches. So that's, you know, even though my non cryptocurrency clients will dabble in it and have questions about it, um, there's a ton of funds that are launching they're doing all sorts of things in crypto, and then everybody's doing different things. It's pretty common to have some sort of staking component going on. There's not a lot of mining for my funds. Um, and, and then NFTs pop up, and some people want to set up a full NFT fund. Some people might want to invest in NFT. So it's really all over the place.
You know, what's the on that same topic, when people are when you get these new funds that are coming to with asking for crypto advice or saying that they want to get into cryptocurrencies, how experienced are these teams? Are these fun? This is somebody who's doing fund number 3, fund number 4, and now they'd like to have more exposure? Or are these a lot of brand new teams, brand new operators that are moving into the space?
Yeah, a lot of my new clients are brand new, fund managers. So they may have obviously they have investing experience, but not as a fund manager, and they're starting brand new, and they're asking how to set up, their operations, where, and we'll tell them, the do's and don'ts. So yes, I think I'm seeing a lot of brand new crypto fund managers.
So that would really kind of lead, and we'll just take a guess here, that it really is that hard to take a traditional up and running fund and incorporate a large percentage of cryptocurrencies, because generally the people that they sought out those initial funds from and did their fundraising, were comfortable with the initial theses. And this new asset class is just that different. Having dabbling in a number of things is just good, covering your hedges. But to say that you're, not 5% into cryptocurrencies, but 95% into cryptocurrencies is really what you guys are seeing is requiring a whole new team, a whole new theses, and a whole new group to really start up and move down that pipe.
Yeah, and you could have a fund, a fund that has established funds in different areas. They're more likely to set up a new fund doing strictly crypto than to try and incorporate it into a fund that's already has an investment thesis going.
What have you seen that in other asset classes or throughout your careers where essentially a new asset class pops up and the funds don't just absorb it but actually have to start fresh to be able to properly navigate themselves?
Well, I guess I see it mostly with public and private securities. So generally, there'd be you would separate those funds into two portfolios, so private and marketable securities. Um, I don't know if I've seen. I mean, I don't know if I have seen an industry start up like this. This seems like it's quite radical.
Very cool.
What advice are you guys giving companies that are giving groups of principals that are saying, where should I set up? Where should I locate? Where should I base this? Are you finding that people are asking that question, or are they just trying to navigate, the money center cities, London, New York, and Tokyo, etc.?
Yeah, so I think the first step is setting up the structure of an investment vehicle, and there's pretty standard ways of setting up those structures, and they typically work very well in a cryptocurrency fund also, and so you have funds called standalone funds, which is a single fund. This is usually a fund that you would invest in if you only have domestic investors. Then there's master feeder structures that can help that can structure it in a way where it has an offshore blocker corporation for your tax exempt investors and your foreign investors, and then an onshore feeder for your U.S. investors. And so that blocks some of the potential ECI, effectively connected income issues, and unrelated business income tax issues that those two types of investors would have respectively.
But
The
with
the
respect to
one
geography, no one's saying, you guys aren't hearing people ask, or you're not telling people to think about another country altogether.
Oh, well, so when it comes to that, so a lot of times the platforms that are emerging to do the trading of these investments um, will not allow a U.S. person or entity to go into that platform. And so what I've been seeing, not a tax thing, but from a regulatory thing, I've seen clients setting up disregarded entities below their fund. And so that just means that they set up a foreign entity that's 100% owned by the fund. For U.S. tax purposes, it's not considered an entity at all. It consolidates into the fund. It only has an additional reporting requirement that's fairly routine, also related to owning a foreign disregarded entity. So that's what we typically see.
And how you were
What are
going to
the
add to that?
Oh
How what?
yeah, it's just a lot of it is because of the offshore exchanges, right? So the ones that's not Coinbase, right? So they don't accept U.S. Account holders. So in order to open an account there, like Binance, for example, you have to use a foreign entity, and they're kind of forced into it, and I think we all know why.
when you guys are, again, we're talking about the really smart ones that are coming to you beforehand and coming to you and saying, we'd like to do this. Here's our plans. Help us set this up. That's the correct way to do it. I'm going to assume that's not always how your first calls go. So for those people that have been in the space for a while and simply realizing that what a very small investment may have now turned into a very large investment, and they're now trying to understand their liabilities, trying to understand the best way to manage these. What's kind of the process that you guys would go through for an intake of someone who's probably not properly disclosed. Made an attempt to in all cases, because we always say pay your taxes. Absolutely pay your taxes. If you made money, pay your taxes. But some people just didn't understand what was happening out in the DeFi space. What's the best way for someone to come to you and be prepared to have that conversation?
So I definitely have prospects that come in and they want to do things the right way and the proper way. But initially, when they got going, they kind of just put it together. They just put it all together, and they might have done things that you generally wouldn't do. They didn't have legal agreements in place. People were giving them cryptocurrencies to trade before there was any entity in place. And then they're like, we're going to set up a fund. We want to do this the right way. We understand that we're not doing it the right way. So I think, one of the good things is that when you start a fund, that's a new entity. So anything that happens before that, you know, can kind of be separated from that. But if you're going to start a fund and you're going to have in-kind cryptocurrency transactions to start that fund, you have to be very careful, because if it's a non-taxable transaction, the cost basis carries over. And so if you weren't reporting that income properly in the past, that issue will carry over. But when we vet our clients, we go through those issues. It could be one way to remedy all of that is through amending prior returns to get everything current and up to date as much as possible. You generally have to go back 3 years due to the statute of limitations. And then you kind of have a clean slate and we can move forward. Now, I haven't had anybody that's had to do that. Usually, when you start a fund, it's difficult to have crypto contributions to start the fund. You need cash to start the fund. And the reason is that the auditors that have to audit it from a GAAP perspective really don't like crypto contributions. So if it's a new fund with cash contributions, everything's starting fresh. And any of those past issues, you get the accounting in place, you get the audit in place, you get the tax professionals in place. That's going to make it that's going to mitigate a lot of those issues you had. It's going to mitigate all the issues you had when you didn't really know what you were doing.
Yeah.
So
What's the trajectory to where you see people being able to use crypto to seed these?
I think it will happen more over time, because I think the auditors will get comfortable with it. And when the auditors are comfortable with it, you'll be able to get an audit, and then you'll be able to use cryptocurrency to seed. It does happen now, but I think there's a very few firms that are willing to accept an audit client that's seeding their fund with cryptocurrencies.
do the auditors understand the difference between stable coins and normal cryptocurrencies? Is that in any way something that they look at as a fund that was seeded with USDC or DAI, different from ones that were funded with ETH or BTC?
Everything you do, you have to look at it on a case by case basis. And so I don't think the auditors do. I don't think, there's lots of things that are happening that people don't have a full handle on. And so that's what happens is we kind of evolve, and we have these different classifications of different types of coins and different revenue streams. It all has to be vetted out. People have to figure it out. The IRS has to provide guidance. The regulations have to catch up. And so it's a messy process. And so I don't know if they do differentiate between those right now. But it may have to be on a case by case basis, and even different cryptocurrencies are on a case by case basis for how they're treated.
It's interesting. I mean, I think we can see the absurdity of the argument because we're pretty far down the rabbit hole. But the fact that the money, if you count crypto as money, the money's on chain means you know exactly where it's been and where it came from, and yet the auditors can't get comfortable yet with that. Instead, they prefer to know where the source of cash was that funded an investment, even though that cash could have been in a number of places prior to being on the books that the auditors are examining. I mean, it's to me, it's not that I see the audit function going away necessarily. I don't think that'll ever happen, but I definitely think that industry, your industry perhaps even, is in for a sea change now that you have sort of self-declaratory properties or immutable properties in terms of where funds come from and who they belong to and who they belonged to in the past. The statute of limitations question, is out there all the time. Whether it's law or accounting. The irony being, though, that you can look back at a single, uh, you know, derivative of crypto and find out exactly where it's been for time immemorial. And it's kind of interesting to imagine that the auditors are hanging up the innovation in some manner, not totally, but in some manner on that topic, because of course it's a lot cleaner, or at least in theory, it's a lot cleaner. I know there are examples where it isn't, but
Right. I think it's just, I mean, it's a transition. And so, even, you're saying it's more straightforward than cash, but it is a transition. And so it takes time for everybody to kind of get up to speed with that. So it could be the better way of doing it in the future. It's just the people, we all have to catch up to it, unfortunately.
and
Do
it's
you
the
see
idea
any?
that people aren't yet ready to stick their neck out and say we're okay with this because they're not sure whether the regulatory agencies or the IRS will, or the SEC for that matter, will grant them a pass when they make those statements. Is that the idea, or is it the like the FASBs and the self governance type agencies, groups and committees that auditors are concerned about?
I probably can't say for sure because I'm not an auditor, but I mean, it's probably a combination. It's probably a combination of both. And with an audit, the firm is liable if those audits are not accurate, and so they have to make sure they can prove everything out, and they just don't have they're just building up the technology and the knowledge to be able to do that. It's a different approach than you would take with something that's being funded by cash.
And on that note, let's talk about the tools. What do you guys yet have good tools to track your clients, or do your clients have good tools that they're using to hand to you guys? And on that same note, has the IRS, who has very good tools for auditing and everything else, have they even come out with and anything to help them through this process?
Yeah, my clients typically have, we encourage, oh, we don't, by the way, we don't track them. It's really the client's responsibility. And our clients have used various types of crypto software out there, and some are very, very good. Spit out exactly the the data we need. Some even fill out some tax forms for them, right? So that's great. Now, I have not gone through any RS audits, so I don't know how they're going to figure out, besides relying on what, the data that the client provided. So Ed, do you have experience there? Or?
Yeah, no, I think one of the things that right now there's a huge need is the accounting for these things. Not necessarily, definitely tax is important, but the first step is the accounting, like I said earlier. And so a lot of my clients that are getting into this space, especially in a family office context where they're not using a professional administrator doing the accounting, is they're trying to figure out how do they account for things. So I think there's a whole bookkeeping industry there for people trading cryptocurrency that I think could be very helpful. And so I think that that's also developing, and we're working with our clients to source those solutions and to find the people that can handle that. And then that helps us greatly when we do the tax function to make sure that we have quality information. Um, and I'd say on the tax side, we have a lot of tools for what we do to do it very efficiently. So in the fund world, everything's a partnership, and so we're doing tax allocations, and the tax allocations can be very complicated. We have an automated platform for doing tax allocations. Um, the nice thing about cryptocurrency right now is it's not taxed the same way as securities are, and so some of the anti-abuse rules that you run into with securities, you don't run into those with cryptocurrency. So the biggest one is a wash sale. You sell something for a loss, and then you buy it back either 30 days before or 30 days after. The IRS says you don't get to take that loss until you dispose of the repurchased security. That's currently not applicable to cryptocurrencies. However, the Build Back Better plan would make that applicable to cryptocurrencies. There's another anti-abuse rule related to constructive sales that's also not applicable to cryptocurrency currently that the Build Back Better plan would change. The only major anti-abuse rule that I think applies right now are the straddle rules, and that would be in a situation where you're doing hedging with your cryptocurrency. And most of my clients haven't gotten to the point where they're doing hedging, but I would expect in the future that that would change as the strategies become more sophisticated. And so basically what this rule says is you go long and short. Let's say you go long and short in the same cryptocurrency, and you sell the position that has a loss, and then you hold on to the position that is a gain. They want to take the tax loss now and defer the gain to the future. The straddle rules don't let you do that. Now that sounds fairly simple, but when you're applying that to 1,000, 10,000, 100,000 transactions, it can get very complicated. Everything we do related to security analysis is algorithmic based. So I spend a lot of time writing code to analyze all of these transactions. So if this, even though the Build Back Better plan is not going through, you're hearing about it. You're probably going to hear these same ideas over and over. At some point in the future, that law may change and they will be subject to it. And at that point, Andersen is ready to go to analyze, watch sales for cryptocurrencies. And not everybody may be prepared to do that at this point, because if you're dealing in a cryptocurrency world, you haven't had to worry about that.
When you're talking about those regulations coming down, and I try to avoid politics as best as I can on the show, but when these are coming down, who's lobbying for the cryptocurrency industry? Do you see a productive lobbying group or lobbying groups around in making sure that there's fair and honestly well-educated people in the space to pass these laws, or are we seeing kind of the TradFi banks try to continue to suppress this new asset class?
There are definitely on the crypto side. There are what call it the NGOs. I can't remember the name now, but one of them was pretty public, and I actually was invited to join. I didn't join, but they do have a different groups. One of the group is about taxation of crypto. So they have people from the big four and various constituents there, kind of discussing, addressing how crypto should be taxed, and they would talk to the government and say make their recommendations. So yes, they're trying to influence this, and obviously you've heard about this recent staking case. You could see footprints of some of that too.
Fabulous.
One of the questions I was going to ask is goes back to the specifics of the wash trading concept. And generally speaking, don't want you to be worried about providing tax advice, but I guess one of the tools that we looked at online said that there's a chance that the IRS could say that even though the wash trading rules don't apply, there's a notion that you're essentially buying and selling substantially the same thing. And in the example was that I read online was taking ether and converting it to wrapped ether, which if you're any kind of a DeFi participant is a fairly common thing. They are in fact different. They're fungible. They're not the same thing, and yet they're pretty much the same thing. So you could take both sides of that argument. To the extent that this is right now treated as property as opposed to currency or security, what are you seeing in terms of that's probably the wrong question. What do you think about the risks your clients are taking or are subjecting themselves to? Are they wise to be conservative right now? Is it the Wild West? Is it let's wait out the statute of limitations and do whatever you want? What do you think people are? How are they behaving right now in your client base?
So I think it's a big hassle to get involved with the IRS and to be doing things that are questionable. So a lot of people want to just avoid that headache. Now, when it comes to the wash sale rules, if you look at the code section, it's literally doesn't apply. It doesn't cover cryptocurrencies, which the industry generally treats as commodities. So a literal reading of the code, you would say, well, it doesn't apply. and it's supported by the fact that the Build Back Better plan is trying to enact changes to the statutes to include them. So that's helpful. But you can also get someone that looks at the code and said, what is the intent of the code? Are you able to do the same abusive transaction with securities and cryptocurrencies? And I think logically the answer is yes. But the statutes are not caught up with the current environment in this new asset class.
I mean, I heard someone say that there's a discussion that you could argue that a 1031 could be subject. You could apply that to NFTs. Does that sound absurd to you?
I thought that after the 2017 tax reform, 31 only applies to real estate. So unless your NFT represents interest in real estate, you're probably not going to be able to
Perhaps it's aspirational then.
apply.
Right.
What's
And I think the NFT is, I mean, I don't think there's guidance on it yet, but I would say it's most likely a collectible, which has its own special capital gains rate of, I believe, 28%.
8%, yeah.
We're seeing people use NFTs as utilities, not necessarily as purely collectibles. And
Okay.
I think that's an interesting discussion point. Has anyone talked to you about the concept of using them as a utility, and does that make sense?
Yeah, I've seen, again, this is, I'm not going to mention, but it's one of the big four firms saying that they actually think there may be a good position to say NFTs are not collectibles. Therefore, the capital gains rate, long-term capital gains would be just like stock, right? So 20% instead of 28%. But I'm guessing that for those NFTs that really represent some sort of interest in a physical collectible items, like say it's art piece, I would think that the NFT is still going to be collectibles. But for other functions, like what you say, utilities, maybe we can have a much stronger argument to say this is a regular capital asset, not a collectible.
It's interesting because they will be, and we are already seeing them sold as utilities or memberships in some cases. The thought around what can be in someone's blockchain wallet, regardless of what chain they're on, can be a number of assets, currencies, memberships, receipts in some cases. I have and so this would be an interesting one that I'm sure no one's thought of, is I have a receipt for an NFT that I used to own, and the receipt has somehow gained value. And so the thought around that of how to even quantify the fact that anything can be turned into a store of value, even something as simple as a receipt that says I owned this at one point, I don't own it anymore, but people want the receipt because there's now value in the fact that I once owned this thing. And so, how does that even come into play when we're talking about never before would anyone have paid for someone's, CVS receipt?
I mean, that's like one of the wildest things I've ever heard. I mean, I don't know.
If I told you the amount, it'd make you even more upset. I mean, people, mine, I was offered $10,000 for my receipt.
Wow.
Somebody else got it right around $50,000 for the receipt. And again, it is just the fact that there's a store of information that some other people feel is important or that they want access to.
Yeah, no, so that's interesting. Like if there's information in that receipt that someone's paying for, I mean, then yeah, I know you probably argue that it's not a collectible, it's something else. So I guess this is just one more evolution. Kind of the NFTs are going to evolve, and this is part of that evolution, and that is, I mean, that's very interesting. I don't know the answer to that.
Neither do I. So that's why we have you on the show.
I know,
None of us know what to do.
On the fund side, gentlemen, how are the fund principals and the GPs looking to take compensation? Are they taking compensation in actual crypto? Are they looking at deferred compensation? What conversations are you guys having about compensation?
So it's pretty standard with how funds are structured, and so there's the standard is a 2 and 20, so a 2% management fee with a 20% carried interest. So you're basically getting a 2% of the assets that you're managing, annually, and then 20% of the profits. Now that can certainly fluctuate. It can be higher or lower, but that's pretty much the standard. Um, so we're really that's kind of what we're that's the main way that they're being compensated. And then sometimes there'll be upfront estate planning that they'll do because when you give an asset away early on, it has less value, so it's better for estate taxes. So you'll have estate tax planning that they'll do. You'll have trusts that are set up, so they'll move things into the kids' trusts and things like that. Um, that's typically what we see. And then they're running a business, and so they do any sort of the deferral mechanisms that you'd have in place for any sort of business. They would be trying to do that. There'd be a retirement. There'd be retirement, most likely retirement plans in place.
Yeah,
Very
so
cool.
as you were saying that, yeah, sometimes they, the compensation is in cash and sometimes it's in crypto. Because a lot of times they choose crypto because that gives them, let's say, some sort of a tax advantage, right? So maybe deferred taxation, or let's say the fund hasn't hold the asset for more than 3 years, and so which if it's longer than 1 year, it's good enough for the investors, but not for the GP. As you know, the GP has to get 3 year holding period to get long-term capital gain treatment on the carry. So they rather opt to take the crypto and then hold it before they and once it gets to 3 years, then they sell it, get long-term capital gain. So sometimes there's that consideration.
And is that those? And you specifically mentioned that the 2 and 20 model. I guess the history of that comes out of the costs necessary to set up registered funds and recruit team members. Is that? Do you think that's holding? Is it? Which way is the wind blowing on 2 and 20 in the crypto land? Do you see it going larger or smaller, if you had to guess, or is it staying the same?
It's mostly the 20%. Um, and I just see it kind of bouncing around that number. I don't see a trend versus one way or the other. But you would think that when someone came up with the 20%, it was pretty arbitrary, and it's amazing how that has stuck for so long. I think one of the things is when you're investing in a fund, that's quite expensive. If the investment manager is taking 20% of your 20% of your profits. But I guess what you're getting with that is you're getting an investment manager that's full time working with a team to manage these investments. You get better diversification because you have a pooled assets structure, and you get better economies of scale on the expenses. And then you get all the assurances that everything's being done in a professional way due to the regulation around having a fund. Um, usually they've hired a law firm, and usually we're the second down the line, and then there's an administrator. So I like to see that they're working with a law firm that has experience in this space. Um, and then I like to know that they're in the process of looking for an administrator that will be able to do the professional accounting of everything. Um, those are two things that I look for. If someone comes to me and they said they're going to do it internally, if they're going to do the accounting internally, that makes me very nervous because a lot of times people are taking on more than they know. They think it's manageable, but it can get very unmanageable very, very quickly.
It's very different than someone saying, "Hey, we're going to manage this retail operation and use QuickBooks or any variety of tools that are existing, and there's a standard workflow that they may have been using for years."
Yeah, and in QuickBooks, you can definitely use QuickBooks to do the financials. That's not a problem at all. But there's also a portfolio accounting system that needs to be in place to account for the portfolio of trading, which QuickBooks is not designed to do. And that's where the admins come in.
Yeah, I mean, I think that also in terms of businesses, right, involved with crypto, again, it's really important that they work with reputable attorneys on the structuring and everything. Because occasionally, most of them come to me after they've hired a law firm, but occasionally they don't, and that's what I would advise them. Right, first of all, you need to operate your business legally, right? That's more important than tax. So Tax, you could lose, let's say the tax rate is 30%, you lose 30%, but if you're operating illegally, you lose 100%.
Right.
And that's, shockingly, that's extremely common in this industry. I mean, we see these DAOs fire up and collect tens of millions to hundreds of millions of dollars with no formal structure, no oversight, no recording, no nothing, and then they're shocked when no one will take their money.
Right. Yeah, that's definitely what you want. That's what you want to avoid. But I mean, it does happen because things happen very quickly, and people they want to jump on the opportunities. So
What's the story with uh, custodians and security in this world? It's a little different, right, than in the TradFi world. So, what are you seeing? What kinds of questions are people asking? Or to Jay's point about best practices, what are people doing with these funds in this strange new world?
I don't have a lot of visibility in how the custody works for this. I wouldn't know.
Yeah, I don't have direct exposure, but I've heard of such things in conferences and certain firms. They would only do provide such services to the larger cryptocurrencies. Because somehow this involves like security, right? So all that stuff, and they wouldn't touch the smaller ones. And so I'm sure it's about security.
I love that you guys really don't have like any good experience for that, because that's just how early we are in this asset class. I mean, the fact that there is no, the best practices are just best guesses or best feelings at this point, really showcases a lot that, I'm sure you guys are subjected to a number of conferences and webinars every month, and that no one's ever sat down and said, here's a good flow, here's a good flow for an ecosystem for a crypto fund. Here's a really good way to deal with custody. And the fact that no one's speaking up outside of probably the vendors themselves to say, here's how we do it best. But there's no large firms like yourselves saying, here's how what we recommend to our clients. It really speaks to just how early in this asset class we are, when we're all just trying to figure it out. What
Well,
are what are
yeah. Also, I mean, with Anderson, that's probably outside of what our specialty and what we would do. So we generally wouldn't be involved in it. We get it with, when we talk to prospects, a lot of times they'll ask us for referrals for various things, and the custody hasn't been something that's come up a lot. It's mostly legal and admins.
what are some of the, and I know there's some obvious ones, but what are some of the real big just no-nos, like that absolutely, if you're thinking about doing A, you just need to stop and really take a second. And so we hear about people raising funds prior to formation, but even during formation, and when they've got the legal structure, what are some things that you're seeing, if you're seeing anything at all, that's just a common occurrence that people just are, for lack of understanding, doing that they shouldn't be doing?
So I think one area of risk is when you bring in foreign investors into the fund. So there's different things that occur when a foreign investor invests that cause them to pay U.S. taxes. Generally, capital gains are exempt from U.S. taxes for foreign investors, so that's very good. However, for hedge funds that trade marketable securities, they rely on something called the trading safe harbor exception, and that's for securities and commodities. However, since cryptocurrencies appear to be commodities, their rules are different. And so, for a commodity to meet the trading safe harbor exception, it has to be traded on a futures exchange, and a qualified futures exchange, which is generally probably a U.S. exchange, and maybe there might be a few foreign exchanges that qualify. And so right now, I think the only cryptocurrencies that really are traded, there's only a few cryptocurrencies that are traded on futures, but that's gonna probably rapidly change. But so what that means is that if you have foreign investors and you're doing active trading, you're not buy and hold, you could potentially have ECI exposure, or effectively connected income, that the foreign investor would need to pay taxes on. And you're required to withhold on that. And if you don't withhold on that, the IRS can come get the money from you instead of the foreign investor. So the idea is, once the money leaves the country, the US is going to have a hard time recovering any taxes. So they would go to the fund manager to get those taxes. So this is an area, I think, where there is some risk. and there's been some discussion, if Bitcoin's a commodity and it's a cryptocurrency because it trades on a futures exchange, can you apply that to all the other cryptocurrencies? They're just like Bitcoin. They're just, and I think there is some authorities that would say that that's not the case. You have to look at each commodity separately.
And I would agree with that final statement. I mean, there is each one's individual, and so there's a very big difference between Bitcoin than there is Doge, and very big difference between that and an Aave, which is an actual protocol. Even though I think most people have no idea when they're buying and selling cryptocurrencies what these things actually do or what they're related to. I mean, I see people constantly like, yeah, I own a lot of Bitcoin Cash. Do you know what that is? No, it's just some random thing that just keeps to existing, but there's no dev team behind it, but it's there. So I think that education, which is one of the things we keep pushing very heavily into the space, is desperately needed, and that means going outside the TikTokers and the YouTubers that are pumping these coins for the pump and dump schemes. That at some point we need, the traditional professionals to come in and explain these things in really boring English, really boring tax terms, because that's the biggest difference. And I think that one of the things that you guys just have said and said repeatedly is, you know, proper tax representation, whether you're a fund or an individual, will absolutely change your strategy if done right. And every year, probably every month or a week, depending on how often these things comes down, you need to have a resource for that. And so I guess, do you guys publish a blog? Do you do webcasts? How do you best inform your clients of these changes where they need to be advised and adjust their trading strategies based on that?
I think we've published a number of tax releases uh, over the last few years, addressing whether it's funds or individuals invest in crypto and how the taxation, works, or at least people should be paying attention to. So obviously, that's an area that we'll continue to, or that's a way we continue to use to, communicate to clients and potential clients.
So yeah, we have a national practice that monitors all of these different court cases for all the industries that we have clients in, and then we do publish these newsletters. We work with the National Tax to do it. Highs publish quite a few of them, and that's generally how we get our information out there. I think anybody can go to the Andersen website and subscribe to our newsletters to get just get tax breaking tax news information that we put out, um, and that's how we do it.
What kinds of, let's talk about sort of that marketing angle. What kinds of things are you two specifically focusing on for the next 12 to 24 months as you guys build your practices? So you're at one of the largest and biggest brands in TradFi, and yet you're doing alternative investing, which puts you on the edge. So you guys have resources, and yet you're looking for the next big thing. It would appear. Tell us about where you're marketing and where you're investing your efforts to try and attract new business in the next 12 to 24 months.
So I think definitely the crypto space is an area that we're targeting, um, and we have a very strong network of admins and attorneys that we work with, and so there's kind of what happens is there's a lot of referrals. There are a lot of referrals that go back and forth, and so we put a lot of energy in the crypto space. Traditionally, I've done mostly hedge funds, but right now I see that there's a much bigger opportunity with the cryptocurrency fund launches, and it doesn't seem to me like it's slowing down. It seems like it's speeding up. I mean, it does go down when crypto is there is some correlation with the value of cryptocurrency. So when the markets go down, there's less launches, but when they go up, you see a lot more launches. But over the last 5 years, it's been a pretty steady flow. And I see my portfolio of clients, the portion that's doing crypto is going to be increasing over the next couple of years.
Yeah, I'll add to that. Basically, more than in any other area, there's within crypto, there's a lot more referrals from existing clients, or I think the reason is that there are far fewer qualified tax professionals that are knowledgeable in this space. So if your friend is using a good crypto tax expert, you're going to use it because you don't have any other alternatives. And also, it's so much more decentralized. Basically, I have clients all over the world because of that. They don't care about. You don't have to be located next to me. You could be anywhere, and as long as you're good. Um, the other source is uh, our international network. So for example, last year I received a lot of referrals from a UK venture capital firm. I would never have any contact with them except that they have contacts with our UK firm, and they funded a lot of blockchain companies, and looking for some of them looking for U.S. tax advice. So my colleagues in the UK kind of refer that to me, so we're going to see a lot more of that going on. So now, of course, Latin America, it's I think it's heading pretty big there. A lot of people are interested in investing or starting companies in that space, and I've been asked to present to our Latin American colleagues about what we can do here.
Interesting.
I think
So
we also do a lot of work with family offices, and so a lot of people investing in crypto have have earned a lot of wealth very quickly, and now they're diversifying their investments. They're thinking from a family perspective, and so we're working with a lot of people that have made a lot of money in crypto that now, you know, they're probably still doing a lot of crypto, but they're diversifying their assets too, and so we're working with those family offices.
you mean the smart ones that have pulled some money off the table and aren't 80 180% up and then 90% down and then riding the waves back and forth forever,
Yeah, I mean, you just see people that use diversification as a tool.
which is smart.
So, guys, one of the cases that popped up in the media that, and you alluded to it earlier, that not everything is as it seems. It involved a district, federal district court talking about taxation of staking income. I guess all of us want to know how to read the tea leaves on this. What do you think it means, and what's an accurate way to describe what happened, and what are the paths you see forward, whether it's the IRS or the other courts on this topic?
Yeah, so basically, I think this is what happened, right? So it's a couple in Tennessee did some staking and received, I think it's 8,000 Tezos in 2019. They initially filed their tax returns reporting that as income, and then later they amended their return demanding a refund, which is about $3,800. And then they didn't hear back from the IRS for a while. They decided to sue the IRS for a refund, after which they got communications from the IRS saying, "Hey, we're going to refund it." So, so that hopefully they'll drop the case, right? And they declined the refund, and they're saying, "No, we're going to go to court and really settle it in court." Their rationale is that they want a clear ruling from the court that this is not taxable upon receipt. It's only taxable when the Tezos were sold for cash or whatever other things. And so that's where it stands. They got support from I believe it's Proof of Stake. Is it Alliance? Which also wanted to get this clarity. Obviously, they would like the IRS to back off and admit that this is not taxable upon receipt and it's only taxable upon sale. It's at this point they haven't started. I think it's scheduled for a court, rule next year. It's for next year. Anyways, it's going to be a while. It's far away from in the future, and even if the court rules in favor of the taxpayer, the IRS could still appeal. So we don't know how long we'll see the end result of this. So I think that as of now, it's still not clear, right? It's not clear why the IRS decided to concede and refund. And could it be just they don't want to go through a court fight just for $3,800, or it could be something else? We have no idea. So at this point, I think it's too early to say, hey, the IRS lost, and therefore we don't have to report staking income upon receipt.
Now, this is not uncommon. Whenever there's a new, I mean, they're still using very archaic, very old regulations for the normal internet. When we think of the DMCA and some of these kind of outdated protocols that are used for counting or copyright purposes today, it's not really out of lines for the IRS or someone else just to lean on something and say, it's close enough. We're gonna go with this. This is new standard, which is maybe why they were just trying to refund, because they were going, crap, we kind of like not having a ruling on this, not having any clear decisions. Um, what's your feeling though on just, and again, this is an opinion, nothing of advice. What is your opinion as a professional in this about how staking should be treated?
Yeah, that's okay. That's tough to say. Now, I could say that. So this goes back to 2014, right, when um, the IRS issued a notice saying mining is taxable upon receipt. So if you mine Bitcoin and you receive Bitcoin because of that, it's taxable right away. You don't wait till you sell the Bitcoin to pay taxes. And obviously that's not exactly staking, but you could argue that it's very similar. And this is why most people until now think that staking income is taxable upon receipt of the staking award. And so in that case, I would say that the IRS is going to, try to defend its position and try to say this is taxable in a court fight. Because otherwise, if they lose this, people are going to say, well, mining shouldn't be taxable either. And I think that's a big deal. I know a lot of even publicly traded companies are in the business of mining Bitcoin. That would defer their taxes a lot, right? That a lot of money is at stake. In terms of the IRS's position on mining, it's kind of controversial, right? So in most cases where you manufacture products, right, you don't pay taxes until you actually sell them. It's not when you manufacture them, right? But the IRS, I could see their point. They're thinking that, hey, you come up with these bitcoins. Well, you could spend it any time, right? This is just like money. Except they're also saying bitcoins are not currency, right? So they're sort of contradicting themselves, and so that's tough. It's hard to say where it's going to land, but um, this could have huge ramifications. When this is settled. Um,
To in your minds, in any way, shape, or form, and again, these are opinions, these aren't facts or anything else, but opinions. Do you believe that the US, tax organizations would prefer to see blockchain based accounting, where it's public, it's on chain, and once they have the tools, there's it's either correct or it's not. They don't have to come hunt and do these closed door audits anymore.
Yeah, I think that's definitely the potential of it, is to have a better system of accounting for everything, and I think that could eventually be very very helpful and make it very transparent what's going on, and then it's easier. You don't really have to hunt. You just know.
Yeah, I mean, especially when you're thinking about managing the security on chain. You can absolutely do that behind closed doors. But if you want to know if something, illegal or immoral is happening, you have to do the audit. You have to go dive in and look at it. If it's on chain, it's generally not transparent to everyone. But if an auditor has the correct key to see what they're supposed to be seeing, it's all there. And so I really do look at this as, not a fad. But clearly this is the future of the financial industry. Clearly it's coming. It's going to take, maybe another 5 to 10 years to reach mainstream for certain companies. Banking is going to go kicking and screaming the same way the record industry went with this, same way the movie industry and Blockbuster went. But are you guys clearly who you're working in and around this asset class? You feel like you've got a long, prosperous career ahead of you doing this?
I do think that. I mean, I think it's going to continue to evolve. So who knows what it's going to be like in 10 or 20 years? But I think I'm not doing this as a short term. I'm not working with crypto clients on a short term basis. It's more of I see the long term potential to it, and so that's why we're in this space, and that's why we're assisting these clients.
Love it, love it. Ed, hi. How can people reach you if they're if they're either A, getting ready to start a fund, or B, need a little help with anything they may have done in the past? What's the best way to get hold of Andersen?
Both our phone numbers and our emails. So that's always a good place to start. And also the Andersen website is another place to start. But you can contact Hai and me directly, and we're happy to assist and kind of vet things out and see what kind of services make sense for us to provide.
Fabulous, love it. And one of the things we always do for our guests is we give them a gift. It's an NFT. It's artwork. It's a gift. Hopefully, you don't have to claim any taxes on it. But Mia will absolutely get your ETH addresses if you have some, and we'd love to go ahead and drop you one of our yWhale crystal whales. Guys, it's been absolutely fabulous. I have to tell you, this is one of the hardest interviews to do because it is a challenge to understand the space in and of itself today, let alone the implications of what you're doing for a regulatory body that has no clear guidance and really doesn't understand the space as well. So I really applaud you guys for being trailblazers in this and doing everything you can to protect your clients, advise your clients. And I really look forward to speaking with you more over the years so we can kind of watch this entire thing evolve together.
Thanks, Jay.
Thank you.
Thanks, guys.
Good. All right. Thank you, Whales. There's
All right.
another one.